Hey everyone, in this video I'm going to take a closer look at IBM and ASML and answer which one I think is the better tech stock to buy today. Of course, both of these tech stocks are benefiting from the rising effectiveness of artificial intelligence, increasing enterprise-wide spending worldwide. So we're going to take a closer look at these two and I'll answer which one I think is the better buy. Let's jump right in.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the first metric I'm going to look at comparing these two is revenue. And looking at a trailing 12-month period in the last decade, ASML, you can see, has been growing its revenue while IBM has been declining. 29.83 billion for ASML and 61.86 billion for IBM. Of course, ASML has this innovative technology that very few are able to duplicate. In fact, it is a supplier to companies like Taiwan Semiconductor Manufacturing, and that's giving it a significant advantage in the rising effectiveness of AI because more and more companies are wanting more and more semiconductor chips. IBM, meanwhile, has been transitioning, shedding some areas of the business that are not growing as quickly, focusing more on growth areas, and that's been helping the company recover, although it's still down in terms of revenue because of all those divestitures over the last several years. The next thing I want to look at is the operating profit margin, but I want you to understand what economies of scale are. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from 100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. Okay, so now that you know what economies in scale are, you can see ASML clearly demonstrating that metric, economies in scale. You can look back 2015, they were nearly identical in operating profitability, and then it diverted where ASML continued moving higher as its revenue increased and IBM was moving lower. In recent years, IBM is recovering, although still longer term its trend is downward. So ASML clearly better here. 32.81% operating profit margin, more than twice the 15.16% for IBM. Cash flow from operations, similar story here, although less severe, because you can see ASML has come back down here in recent years. It was demonstrating that separation up until 2022, and now it's closer. IBM, in fact, in the lead here, 22.52% compared to 19.75% for ASML. But let's look at the prospects for the next few years. If you look at revenue growth expectations for IBM, it's modest, 3.1% in 2024 revenue expected, 4.5% growth expected in 2025, and another 4.5% expected in 2026. For earnings per share, similar, 4.9% earnings per share growth expected, and then 5.5% for 2025, and another 5% for 2026. reasonable growth, not exciting, not what you would expect from a tech stock, but IBM is a mature company. It is a tech company, but it's mature. It's been around for decades. And so it's not one of those younger tech companies that's still in the hyper growth stages. So very low to mid single digits revenue and earnings per share growth expected for IBM over the next 3 years. Meanwhile, for ASML, 0.4% revenue growth expected in 2024, and then a jump to 24% in 2025, and another 11.6% in 2026. For earnings per share, negative 4.2% in 2024 expected, 44.7% expected in 2025, and then another 20.7% expected in 2026. Of course, these estimates I shared with you are from a collection of Wall Street analysts that are following ASML and IBM stock. They submit their forecast for where they think revenue and earnings per share will be, and this is a collection of those estimates. And the consensus number is what I shared with you here. So given all of this information, let's compare it and let's weigh it against valuation. And the metric I chose to use is the forward price to earnings ratio. So I want you to understand why this metric is an important metric to use. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. Okay, so now that you understand the forward PE ratio, IBM is significantly cheaper at a forward PE of 17.22. Meanwhile, ASML is trading at a forward PE of 30.5. So the question here is, does ASML deserve this premium valuation? And to answer, if they were selling at the same price, I would go with ASML stock, no brainer, easy choice. But since it's more expensive, it takes more consideration. Still, even after considering the fact that ASML is selling at a premium valuation compared to IBM, if I was to choose between these two tech stocks, I would pick ASML today. I think its advantages in the proprietary technology and its market share and its dominance of its position in the industry gives me comfort in knowing that it has pricing power and demonstrated that through its operating profit margin, which we saw was so much better than IBM. So for those reasons and the better prospects over the next 3 years, I would pick ASML stock today. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.